Hey everyone, welcome to this week's edition of Bulls versus Bears, episode 127. While JT's away and Finn's away, or as what we like to call it, the optimistic crowd. Kai and I, being ex-bond traders, we're a little bit more bearish than the equities traders. So we're doing the be fearful when others are greedy episode, and it's going to outline some just some risks that, and I normally keep a little tally of risks. But I think it got to 12. The list got to 12 this morning, and I thought, probably not a bad thing to float them and discuss. So, and just for the record, a disclaimer: I'm usually early, at least a little bit. So, this is don't be taking my advice immediately, and just do your own research and all that sort of stuff. General advice warning. Kai, welcome, my friend. I've sort of skull dragged you into this as well. This is, as much as it'll be a little bit of a bearish episode. I've had to drag Kai kicking and screaming. Yeah. Yes. But you guys have been bearish the last couple of weeks. So, and we have a new leader, just by the way. It's you have been the leader for the first 27 odd weeks. And I was coming last. I think I was 1 from 8 at one stage, but I've sort of learned over the course of the last few years in particular, is that every time I really feel like it's going to go down, it's probably another 2 weeks more. So, and JT, of course, submitted his tips and before he left to sail solo to Japan on his yacht. So he was, you two were unfortunately didn't pick up a point last week, but S&P, NASDAQ, it was pretty much in the last day and a half. Personally, I spent most of this week completely regretting being bullish until yesterday and today in terms of this competition. But pretty amazing bounce back. And it just seems that nothing can keep this down. 170 attacks from the US and about the same from Iran, or about 100 attacks from Iran. And the war's basically back on. The ceasefire's over, and back here we are, back up again. So it pretty odd sort of week, I've got to say. But it is thin holiday.
The market's got noise cancellation on, that's for sure. Because there
was a funny news story this week. Someone set a Guinness World Record for the world's quietest room. It was like this soundproof room, and apparently no one can stay in it for longer than 40 minutes. It actually sends them a little bit nuts. I think the NASDAQ and the chip sector's comfortably in that room for the last 3 months. It's like it won't let anything in. I mean, some of the fab manufacturers got a little bit hit. You can see in the middle there next to Tesla, and they're sort of the industrials manufacturers. But look, they've sort of bounced back a little bit. But you can see where the green is. Obviously, Micron was down a touch. But has been on an absolute tear, and but Nvidia's now allowed to sell to the Chinese are now allowing the Chinese developers to use Nvidia, some Nvidia stuff, and that's why they were up. And Apple, I believe, announced a deal with Broadcom. That's why both of those guys are up, make their chips and stuff. So. Meta, I'm pretty surprised, is only up a little bit, but Zuck's had a lot to say this week. I've got to they're going to start making their own chips. They're also going to start he said the amount that he's getting offered for his compute, he's going to start renting it out because it's he said whilst Meta is short on compute, the amount of money that's being offered it's too good to refuse. Elon's been doing that for 3 or 4 months. He's been renting to OpenAI and Anthropic, and we all know Sam Altman's immense control over budget. He's probably making a fortune out of him, I'd say. And at that massive, that massive joint in Texas. But yeah, Anthropic's got half of that compute now, nearly.
Yeah, right.
That Elon built.
I mean, I'm not too surprised Meta is going down the route of making their own chips. It's natural. It makes natural sense, like because they're pretty similar to Google, where they, all the data centers and all the data racks, they actually make their own boxes. Like if you've been to data centers before, it's pretty interesting, right? Because you got the standard mill like HPE enterprise servers or Dell or whatever. You put together different servers and all this stuff, right? But when you start getting into the scale of like Meta and Google and Amazon, like a lot of these racks are custom compute, right? So it's like they have to create their own boxes to be more efficient, and so forth. So it doesn't surprise me that they go one level down and just go, you know what, like we're going to build our own chips, we're going to build our own stack, and they'll have the whole vertical integration there. So it makes sense, yeah.
Yeah, well, I mean, and they're apparently a lot of their AI spends been aimed at their advertisers, like as in optimizing their spend. So I kind of get why they've been a touch secretive about it, because everyone knows that stuff goes on, right? But like that, your data's basically Meta, Google, and everyone know everything about you known to man, basically. And hearing a little story about some outdoor advertising companies that in the last week as well, where they're basically geo mapping people and changing signs for changing signs on the basis of who's walking past, because we've all got a bloody a GPS tag in our pockets with our phones and stuff. So but you don't really want to. I guess I had a bit of an adverse reaction to that. I'm like, holy crap, how can they? And then we all kind of know in our heart of hearts that we've got no privacy, but I think that's where Meta's probably not being overly public about the fact that they're increasing margin and targeting for their advertisers, and that's where a lot of their AI compute's been going. So they've still been making okay money, and I think they've had okay earnings seasons and stuff as well, but except for their blowout capex. But Zuck loves to spend money, and he's renowned for it over the last few years. Although he can always rest on that Instagram purchase.
Yeah,
which I
exactly.
remember at the time I was in markets, and I wasn't in stock markets though. I wasn't in single stock and US particularly. And when he paid $1 billion for Instagram, everyone was like, "What are you doing?" And now like a billion's like tiddlywinks.
I mean, also, what about WhatsApp? WhatsApp was another one that he acquired.
Yeah.
It's not too bad.
I don't know how much money they. Then he was trying to put advertising on it, and then there was too much backlash, so he didn't.
Yeah.
Obviously,
I think it's where it started going wrong was when he went deep down the NFT craze, where with the metaverse.
And the metaverse, it's still called Meta, right? So, and apparently Apple is going to. They did announce a product this week, and everyone knows I'm not an Apple fan. Or if you don't, well, I'm telling you now, I'm not a fan. Haven't innovated for at least a decade. And essentially, I think their business model's done when the baby boomers and the older crowd die out. Because everyone else is kind of on Android, but they're gonna team up with some luxury brands to do the glasses, apparently. I mean, Meta's really been pushing that barrow, but I was always a little bit concerned that because the ones that Meta made, I've seen the videos and stuff of them, like the ones that they can't release because they're too expensive to make to sell to consumers, they were amazing, like full like holographic head-up displays and blah 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 blah. It was but then they did the end of the video and they had like Jensen had them on and all sorts of stuff. Like they just looked like normal glasses. And he was blown away and he goes, yeah, no, they cost us about $3,000 to make. And that's in-house. We're only going to use them in-house for a while until we can get the cost down. But and then that was 2 years ago. But yeah. But it was pretty amazing. And then obviously the Aussie market, bit of a bounce back in the banks, bit of a bounce back in the oil stocks. Obviously oil bounced back a little bit. Uranium had a little bit of a jump today. There's been some deal done between India and Australia on uranium, and not entirely sure why Goodman Group keeps getting the thick end of the stick, but I think at some stage that's going to. It'll end up being buy of the year, like it's the data. It does like it makes Next DC look like a minnow when it comes to data centers. They're so much bigger than all of those other guys, the Next DCs of the world. In terms of gigawatts globally.
I mean, yeah, exactly. So they have a lot of development on but it's a different model, right? Because like the Goodman groups, they're more looking for the rent of these data spaces as opposed to selling the rack space for Next DC.
Yeah, I suppose so.
Yeah, I mean, it's more. Yeah, it's interesting. I mean, it's more the REIT when you look at Goodman as opposed to the leasing out the data centers. But regardless, their scale is incredible. So yeah, it's
oh yeah, I didn't realize how enormous that, and they're they're in 20 countries. But I'm actually gonna Google it. Well, sorry, Perplexity here in a minute because I would like to know. I haven't looked at it recently. And I'd like to know the numbers myself. But and then really, yeah, we're into now. So this was last quarter, and I think everyone's sort of seen this. And just to give you some context of the averages, I'm really concerned coming into this quarter, and that was the best quarter outside of a bounce out of the COVID lows in 15 years. But the stats would suggest that I'm probably going to be wrong because the average is about sort of averages around about the I don't know the 4 and a bit mark, 3/4. For the next quarter, so at 3.2% generally, the next quarter will be up. There was only really one down quarter after. This is the best, the top 5 quarters in the last 15 years. So it generally has been a little bit bullish straight after. So and only one all the way back in 2012 where it's been bearish. So look, I mean, like I said, every chance I could be wrong. But it when you've got, I think it was 87% of what the index has added was in the semiconductors. So basically, the rest of the market has actually hasn't gone that well at all, to be honest. So, okay, so Exhibit A, and these are in no particular order, and which I've just realised for myself, but I was trying to be very prepared today. So margin lending is gone through the roof. So for those of you don't know what, margin lending is pretty accessible in the States, like Robinhood and all those guys offer it. And this is retail margin lending, right? So so the regular punter investor, not the instos, but that'd be impossible anyway because they'd use options and all sorts of stuff. But essentially, like we're at we're at record highs, obviously, but money supply is bigger as well. But as you can kind of see, when we have those dramatic spikes, and you can see there back in 1999, there was a really steep spike up, and then we fell away in 2007. We had a really high run. So you can kind of see it correlates. Then I think 2019 is probably not, or 2019-ish should be probably not a bad example where a normal pullback. But then and obviously it exponentially has gone again, and what I don't like about it is that, you can, when you get a margin call, you got there's no choice, right? You either pony up the cash,
That's right.
and
It's forced liquidation. So regardless of what your position is or your long-term views, unless you had the margin posted, they will stop you out. Which means exit the position at whatever price.
and if you don't, they press a button and they exit at whatever price. So, and I don't know whether the worst person in the world to get you out of a position is a risk manager. Let me just tell you, I've been on the positive end of that, because where someone's liquidated, and I'm sure you have over the course of your trading career as well, Kai. Like we'd never. I mean, we were margin call back in the day, but we could pony up the cash. But I mean, it gets ugly when people have to get out. So and this is another thing as well. So we're starting to see a little bit of volatility come back into the market, and everyone says, well, that's not true. However, and you're going to have to explain dispersion, Kai, because I'm only. But so the volatility is around 16, which is very calm. But the single stock or the intersector dispersion, it means the volatility is at 40, and 40 is a lot, right? Like that's high, that's super high. And when we're even just starting to see the index volatility come back up, but please explain dispersions and help me out here. I'm floundering.
For the option geeks out there, the dispersion is usually like what's happening is you've got a basket of instruments or stocks, and basically in that, for example, on today we go buy into this dispersion event. You get the average price, you get the average volatility and price of this, and then after a period of time you observe it again. If they move apart, so they spread further apart, there's larger dispersion. And then if you're long dispersion, you make money out of it. If they move all in the same way, then no good. Pretty much as simple as that.
So dispersions so basically like the likes of for a good example, intersector dispersion in the ASX in the last 2 years. The banks remember like 2 years ago, the banks were up and we were copping crap because BHP was still at $34, and materials were way down, financials were way higher. And then like the last year, materials are up 60%, healthcare has been hit 21%. Like that, that's not. I mean, yes, there are cycles and things that make that, but that usually that distance is not so far. And what they're sort of saying, and that's a very crude example of it. But basically, the index looks really calm because last year it was the GPUs holding it up and everything was hidden by NVIDIA and the hyperscalers. And now that the hyperscalers are dropping and there's movement all around the place and in all the other sectors, but the memory chips keep going up, which kind of hides it as well. So at some juncture, but it is like it's been brutal. Like if you're a fund manager in Australia this year and you've made 2 bad calls, you're screwed. Like, and as much as I always hack on fund managers for being a bit gutless, last year was a hard one. Here is number 3, the big borrowing binge, and we've shown this in the podcast before. And it's not really the number; it's more, and like everyone's seen this, right? And the fact that they're raising in Europe as well kind of concerns me because usually if they can just get it done at home, they get it done at home. But it's not. But it's not the number. It is the fact that Amazon did a 25 billion raise this week, and the bid to cover ratio dropped from an average of 3.2 to 2.5. So what a bid to cover ratio is how many people want the debt, right? So how oversubscribed it is. And it can be 2.5 times oversubscribed, but you can also bid at a lower yield. So they actually had to offer an extra 20 basis point yield to get the deal done. and Amazon has issued $92 billion in 2026 for the half year alone. So that's more than Meta, Alphabet, and Oracle combined this year. So everyone's kind of, but what it sort of says to me is everyone's kind of full. Like if the demand's dropped because they're probably running out of money. And another one of the key stats we're sort of looking at is this put call skew, and so basically what that means is when it's a low number, no one's buying downside protection. So and look at it, and we obviously, where other periods like 2024, 2025 periods where we did actually have dips, it's been down towards this sort of low, but that, that combined with the fund managers have actually got apparently less than 4% cash, or 3.2 is the record low, but we're at 3.9. It sort of means that no one's got any dry powder. They've got no downside protection, and they've got no dry powder to continue buying. And then you obviously add margin debt to that, and all of a sudden so it's kind of more in combination. Those three things, like leverage, and the market being a bit overstretched in terms of not having any extra cash or cash allocation. Like I always find markets always go harder when people feel like they're missing out. But if you've got all your cash allocated, well, you don't, you've obviously been able to get set. So they've got less dry powder now than at any point since the survey started in 1999, including the .com. So yeah, that obviously is a little bit of concern as well, because I mean, even if retail was to be the ones to prop it up, which is very unlikely, they're obviously they're maxed out on those margin lines. So that's kind of where I'm a bit concerned. It's not any one of those things necessarily in isolation. It's three or four of those things combining together, because you can everyone goes, well, you should always buy the dip, but if the big guys don't have money to buy the dip, the little guys are getting auto exited, and no one's got downside protection. Don't have much wiggle room for things to go wrong. So yeah, I mean, look, we could have a bumper earnings season, and this thing could defy gravity for another 3 months. God knows. Like, I mean, this rally already surprises me in about 25 different ways. But this is what we were looking at, Kai. Remember, in the investment committee, there's the semiconductors making all this money, and the memory chip guys, and then the hyperscaler. The check writers are getting hit, and the check receivers are going up. And I think that's where earnings season might be decided. So, but yeah, because I mean, it's just incredible what, like, the likes of Samsung. SK Hynix is listing on the ADR. They raised $27 billion, largest foreign IPO in history. Which it's not really an IPO; it's an ADR, but deposit receipt. But yeah, but maybe that's where I think we've got. And I'm just going to have a look here. Yeah, we've got like Tesla, Google, and the hyperscalers are set third last and fourth and last week of the month. So it's actually a little bit further along than I thought. So realistically, I think that's where the being potentially bearish is probably, it could sit up here for at least another couple of weeks. But I think that's when this gets tested when the hyperscalers start reporting earnings. It's kind of when I reckon we'll know whether the coast is clear for another quarter or not. Because they're pretty significant. Like, whilst it's been great for the memory chips, if you're paying, it's pretty expensive, right? Like, it's really eating into something that's not necessarily making money on the other side.
Yeah, absolutely. I mean, the cost of memory chips are still sky high. Still a bottleneck in terms of supply. These hyperscalers, obviously, there's a lot of demand for AI. Obviously with the token usage going up, with these new what's the new Anthropic one called? The Fable.
Fable, yeah, where you can you can literally burn about $500 worth of tokens in one simple request.
It'll use all your tokens. It'll give you back 2 words.
Yeah.
Try again. Oh dear. And then I mean, yeah, it's the demand is certainly there. Jokes aside, I think Anthropic's obviously proving the case where there's definitely a use case in most enterprise and retail environments for customers. Yeah, and we need more compute, but these hyperscalers are just paying so much away for these for the memory chips at the moment. So they're hurting. But the membership guys are loving it. I was listening the other day, and they were talking about Korea, right? Because obviously that's the epicenter with Samsung and SK there. They were saying that on average, an employee at SK Hynix was getting paid $1 million bonus.
Wow.
Yeah, I'm not even joking. Yeah, it was like it's crazy.
Well, and look, I mean, I hope the Samsung guys have been sorted out, because apparently as an organization, and Samsung's like a bit of it's their national company, right? Like they're super. You almost get a death glare if you own an Apple phone in Korea, or certainly if you own an Android that's not a Samsung, and but apparently they all got together and took as a union and took a pay cut to save the company when the memory chip bust happened last time. And they're and then SK Hynix guys, and they've actually almost, and they're not the striking kind of people. They don't go on strike, but they're like, well, hang on, our friends over here at SK Hynix that jumped ship and didn't save your ass are getting paid $1 million. Like we took and so and well, it's Korea's form of an industrial dispute, which is, I don't know. Maybe they put I don't know.
They send you to North Korea.
Oh God, no, yeah, or no, but maybe that's like they put a frowny face in the suggestion box or something like that. But I hope they do sort them out, because I mean, if you do sacrifice to the company, it's only fair that you get it back. Next week we have banks. That night on JP Morgan Chase and Bank of America, there's actually also 3 other banks. It actually didn't fit on the calendar, and I was prepared earlier, and now I've lost the file. But Goldman Sachs, Wells Fargo, Citigroup, Bank of America, and JP Morgan Chase. So basically, Morgan Stanley's pretty big, but that's the biggest banks in the world, basically. So we're gonna, and there's a fellow who's like the Bloomberg expert for banks and financials, and apparently they were joking. He's a power lifter. He's a competitive power lifter, and he said, and he looked at the earnings calendar, and he goes, I'm not going to be able to go to the gym that day. It'll be too busy. So yeah, he's well, he basically, like, everything's going to be in one go, and then Johnson & Johnson. Netflix. That's I think the banks were quite late. Usually we would have had a couple by now. I'm not 100% whether that United Health one's right, but BHP is going to have. Excuse me. He's going to have the quarterly as well on Thursday, which will be pretty damn key. Everyone's pretty bullish copper. And then we've got the full, this was the beautiful slide that that Finn did last week. But I think these ones here in the middle are probably, and obviously the ones we'll be watching at this earnings season, but kind of got a bit of an inkling that these guys, and I quite like Iron as well, which is an Australian-based company, which is used to do Bitcoin data center solutions, but realized that there's 5 times more margin in doing. But they already own everything. So and they were already like at the top of the tree in terms of Nvidia and stuff, because Bitcoin miners kind of got into this before the AI guys did, and they've got like loads of full end-to-end data center stack. Like, not they got cloud, they got compute, they got GPU, they got everything. So kind of that's probably where we're kind of looking. But as I said before, I probably wouldn't mind seeing how the how a couple of the how well received a couple of these hyperscaler earnings are before we get too carried away. Like I say, then that's not till well, that's not. We're talking a week and a half. We've got a week and a half yet, so you'll have to excuse my bearishness today. But and you'll notice that Kai's been quite silent because maybe he's just not agreeing with me. But look, I think it's definitely an opportunity to kind of review and have a look at your portfolio, because there is a lot of things stacked up on one side, and I think it warrants caution at the minute. As in, we joke around and we're bearish, but like I very much do not like that combination of the market being overstretched, no cash, and loads of leverage. And then bid to cover ratios in those corporate bonds dropping just means that people are just genuinely running out of cash and running out of steam. So we'll have Newmont as well on the 24th, and Fortescue. So towards the end of the month as well, and then we're going to be like full on into Aussie earnings season as well. So so that will be interesting. Much more dangerous than US earnings season, because it only does it's like the reverse of our index structured products, Kai. The downside moves, the leverage is only to the downside for Australian earnings season. It's never, nothing ever jumps 40%, but they can smash Cochlear 40%. It's a
good point. I don't remember the last time we saw like a 40% incredible spike after earning. What was the last?
Yeah, no, in Australia, not a chance. I think like Megaport was up like 30 or something, and that was on like on a GPU as a service deal. If that had been in the States, it had been up 130%. Like, seriously, like it's so hopefully there's some I reckon we'll get a little bit of bounce back, but yeah, I to be honest, I'd rather walk through an old minefield that hasn't been cleared than punt on Aussie earnings at this point, because you're flipping a coin. So and your upside's nowhere near as good, or nowhere near as going to cover as much as what the downside is. So yeah, commodities. Obviously, crude was back up 4.5%, but it dropped 4% last night. I would say uranium will rally tonight on the back of that India-Australia deal, because Paladin and those guys are all up about 7 or 8% today. Silver and precious metals still down, but that's just the bond yields basically. And our old mate copper, with this the most consistent price action in history at the moment, it just keeps grinding higher. It's it's pretty kind of unbeatable, to be honest. Bitcoin was up 10% early in the week, but finished the week up 0.53. But yeah, so and poor old lithium, I mean, it was on fire as well, but I think the flare-ups in the geopolitical thing have damaged it as well. And pretty and there's a lot of talk around the yen as well, being at historically ridiculous levels, and they're going to have to start buying the yen against the US dollar. But they've been saying it for many weeks. Did you like my fireworks, Kai? Do you see those? I've taken the lead.
Yes, right. Yes, poking your head out ahead. The little bull there.
Well,
oh wow!
It's
taken.
It's taken 27 weeks. We're 191 days through our 365, and it's the only time this is the first time you've not been in first place. Poor old JT can't win a trick. and I've given myself an ultra bear this week in the middle there, and he's all muscled up. You're just still like the normal sad bear. JT's alternative strategy here might actually work for him. God knows, he'll probably be bullish next week, and he'll get us both and pick up some thing over.
It's like when are we going to learn, right? Because the S&P 500, if it goes up, if it performs at 10% a year, I mean, bloody hell, it's designed to go up.
The stats are actually like pretty overwhelming. We should, if we were half smart, we'd just be bullish every week. But that wouldn't be any fun.
That'd be boring. That'd be boring.
It'd be a little bit boring. So yeah, but no, very, very proud of my comeback there, because I literally was 1 from 8 at one stage, and pretty much the only reason that I kept the competition rolling was because I was sitting there going, I'm looking like an idiot. Like I'm gonna have to work again. I started to get in my head, and then it sort of came back, but yeah, but we're back to neutral, fear and greed, like almost bang on the dot. So realistically, I've gone against my normal thing where it usually has to be at least in degree before I start. But so we'll end up being wrong this week, but I can't go through 27 reasons why I'm bearish and then not be bearish. So c'est la vie. But yeah, look, I've almost bullied you into it as well. But anyway, but I think that pretty much wraps it up for this week. We'll have some troops back next week. It's been a long week for Kai and I. We've been hustling all week, and we're on our own, and we'll have Finn Judell back next week. I think I might he can carry the ship and host next week, I reckon. He'll be coming back from swimming in this, and folks, this is a legit story. He's swimming with the whales in Tonga. Hopefully he's a skinny bloke. Hopefully they haven't thought he was plankton. Because we've been pretty stretched, but thanks for joining us, and I do believe we are going, not next week, but possibly the week after. We've got a buy the dip coming up, which for those of you who missed out last time, we just ended up getting enough interest. So if anyone wants to have a look at that, just go to the website as well. It's in the S&P 500, and a little bit cheaper than last time as well. So it's a 3-year index investment, and if you want to get these updates daily, you can listen to the morning call with me, and every morning, and on the podcast platform as well. So please like and subscribe, as they say. And Kai, cheers, mate. We'll speak next week.
Yeah, have a good weekend, guys.